Good afternoon and welcome to Scotia iTRADE's webinar. Today's topic is on leveraged and inverse leverage ETFs with Horizons ETF. Should be able to hear me now. You may want to just click on the sound check from the audio panel if you need to test your audio. If you're having any issues hearing, you can always call in using your telephone. Just use your access code and the audio pin as you see on the screen below. The sound will be muted today for quality purposes, sound quality purposes, so you won't be able to speak to me, but certainly you can converse with me by the sound panel. As a quick reminder, unless otherwise explicitly stated by Scotia iTRADE, seminars, webinars, and other educational tools and resources, collectively the content, are provided by independent third parties that are not affiliated with Scotia Capital, Inc. or any of its affiliates. Scotia Capital, Inc. and its affiliates neither endorse or approve, nor are liable for any third-party products or services, third-party content, or investment loss arising from any use of the content, including third-party content. So the information that we're going to be showing today is for general information and educational purposes only and is not intended for any advice or recommendation. The toolbar that you see on your screen there, the GoToWebinar toolbar, can be used to minimize it or to increase it. Just click on that orange arrow at the top to control the panel. You can view this in full screen mode as well, and if you have a question, you can use the hand icon, or preferably you can just type in your questions in the question box there, and our presenter will either address them directly as you ask them, or we'll address them at the end of the session in the Q&A session. So we will be recording today's session as well. You will then receive an email link within 1 business day, so that'll be tomorrow morning. You'll receive an email link with the recording. And in addition, at the end of this session, I will actually have the deck uploaded as well. You can also visit our YouTube channel. We have a webinars on demand playlist there that you can actually go to see the archived webinars. As mentioned, I will download a PDF version of the deck today so that you should be able to look at that while you listen to the recording that you'll receive tomorrow. The deck won't be available right now. It'll be done at the end of the session. So just give me a minute or so to upload that, and then you'll be able to download it to your own computer. Today's session, Leveraged and Inverse ETFs, is a part of a larger series, the Horizons ETFs Learning Series, and we've sort of been working through that over the course of the year. We're now down to Series 3, the Advanced Trading Strategies Using ETFs. This one then is the second part, Leveraged and Inverse Leverage ETFs that you'll be seeing today. So if you want to see any other parts of the series, you can go to our YouTube channel and you can find the Horizons ETFs Learning Series there to work through them. So today we have Mark Noble, who is the Head of Sales Strategy, VP in Communications with Horizons Exchange Traded Funds. Mark has been with Horizons ETFs for more than 4 years and is responsible for its external communications and sales strategy. He's also the chair of the Marketing and Communications Committee of the Canadian ETF Association. Mark is a strong proponent of financial literacy and ETF education and works closely with Horizons sales and marketing teams to build out client education tools and initiatives that help Canadians become better ETF investors. Prior to working at Horizons ETFs, Mark was a personal finance journalist at the Advisor Group, a leading financial services publication that serves the Canadian financial advisor market. At this point, I am going to pass the control over to Mark, who will then guide you through the rest of the presentation. Mark?
Perfect. Just going to show my screen. Good afternoon, everybody. This is one of the more advanced ETF presentations we do, but we do find it's one of the ones that people tend to be the most interested in. Hopefully everyone can see my screen. I'm going to just pull up the presentation here and put it on slide view. There we go. So this is one of the more, excuse me, fighting a bit of a cold, the more advanced ETF presentations we have. And it talks about a very popular group of ETFs we have, particularly with direct investors, which allow you to, with more risk, potentially generate high returns. But where most investing is dealing with, fairly simple concepts such as buying stocks, buying bonds, this ETF seminar is much more geared towards what I would say advanced ETF investors and traders who are looking to generate higher returns over a shorter period of time, but also trying to understand the risk associated with doing that. So just like sports cars versus four-door sedans, how you get your investment exposure can be very different, and comes with some benefits and comes with some risks. So I'm hoping that at the end of today's presentation, you have a good understanding of how leverage and inverse ETFs work and when to use them, and maybe even if to use them, and so that if you do go forward using these ETFs, you have a greater understanding of where they fit in your portfolio, and hopefully some of the questions that you may have get addressed in this presentation. I'll take about 35 to 40 minutes to go through it, and hopefully we'll have some time for questions. So I'm with Horizons ETFs. We're the 4th largest ETF provider in Canada, and we're also the only provider of leveraged ETFs in Canada, which are tactical tools that help you profit or protect in bull and bear markets. Our business is divided into 3 different businesses. So today's presentation is clearly focused on this area here, which is our Beta Pro and Leveraged and Inverse ETF business, which was the first, actually the genesis of our business. Originally, all the only ETFs we offered were Leveraged and Inverse ETFs. As the ETF industry has evolved, our company has grown with it, so that this only represents about 1/7 of our assets now, and most of our assets are tied up with actively managed ETFs and index ETFs. But of course, particularly with direct investors, who represent about 90% of Beta Pro ETF holders. So these are people like yourselves using platforms like Scotia iTRADE. We spend a lot of time still talking about our leveraged and inverse ETFs, which continue to be some of the most widely traded ETFs on the Toronto Stock Exchange, usually representing a number of the top 10 traded most securities on a daily basis. So we have a number of leverage, inverse, and volatility ETFs, and our strategy for our company is we're what we call market agnostic. That is, we don't really actually take a view on what it is you as an investor should be buying. Our goal is really to provide you with the tools that allow you to get the portfolio you want to have. So I often think of it as being similar to a tool provider that you would see at Home Depot, like Milwaukee or DeWalt, where you can go from anything from small hand saws to large power tools. And of course, on these, we'd probably be looking more at the power tools kind of area of the ETF investing, where we offer both long and short exposure to a number of the most widely followed indexes in Canada. So on the equity side, we have 2 times long and 2 times short. But when I say 2 times short, it means 2 times the negative, generating negative performance of the underlying index, or inverse -1 time. So this table here just kind of highlights the kind of exposure that you can get to the various asset classes into this family of ETFs. So over here you have on the commodity side, you can get exposure to gold, silver, oil. Then you can get 2 times exposure to gold, 2 times exposure to silver and oil, or 2 times inverse exposure to those asset classes. We're also the only provider of volatility, very popular family of ETFs. These are ETFs that track the underlying volatility of U.S. equities, so actually making an implicit investment in whether you believe that volatility, the difference between buying and selling, will increase on stocks. And of course, higher volatility, the higher the return on those ETFs. So our agenda is to look at how leveraged and inverse ETFs work. We'll talk about the effects of compounding. We'll also talk about how volatility and leverage and commodity leverage ETFs work, and then eventually I'll talk about a few key trading and investment strategies you can employ if you choose to be a leverage ETF investor. Now, leverage ETFs have been in Canada for about now over 10 years. 2007, January 2007 is when the first leverage ETFs in Canada were launched. And really the important thing to understand about leverage ETFs and why they were launched in both Canada and the United States is that they work in a subset of investing that people were already engaging in, which is leveraged investing. So historically, before the advent of leveraged ETFs, people still obviously shorted stocks and shorted commodities, as well as used leverage using margin accounts to get exposure to certain asset classes. And typically, an investor who had a lot of conviction about the direction of an asset class, if they believed that they were going to make, they believed in the direction of a direction of an asset class, they could make a leverage bet, which would obviously enhance their return and their risk for over a shorter period of time. And typically, they would use a margin account, or they may enter into derivatives contracts, options. There's all sorts of ways that people could get access to leveraged investing. But the problem with leveraged investing before the advent of leveraged ETFs is that you can actually lose more than your original capital. So if you think of a margin account, for example, if you bought a stock on margin, you put some money down, but if that bet went against you or that investment strategy went against you, you'd be on the hook for delivering a lot more money than just what you originally put down. The real unique innovation of leverage ETFs is that they have what we call non-recourse leverage, meaning that your risk is limited to the capital invested. That is, you can get leveraged exposure to the daily performance of an underlying benchmark, but you're never going to lose more than the principal invested. And that was an extremely important development, because it now meant that a wider swath of investors could get exposure to leveraged investing without using margin and taking on that recourse risk. This doesn't mean it's not a risky way to invest. Of course, the risk of these ETFs is extraordinarily higher than it would be with your traditional one-times long ETFs. However, it is less risky, we would argue, than using traditional forms of leverage. Other benefits of this strategy is it's RRSP and TFSA eligible, and there's no margin call risk associated with any of these ETFs. Now, the really big benefit of any kind of leverage strategy and needing to understand is the universal effects of compounding. Of course, we often attribute to Einstein that the fourth wonder of the world, I believe he said, was the power of compound interest. Of course, that also affects really the returns of these kinds of strategies. So compounding, that is the returns on returns, affects all investments over time. And of course, in an upward trending market, you would see significantly strong returns with these strategies. And in a downward trending market, you would see substantial losses. However, compounding on a negative market also works against you, because the compounding is on less. So compounding is something definitely to understand with these strategies. But also what you need to understand is that positive and negative effects of compounding are magnified in leveraged and inverse funds. So for example, on the compounding on a 2 times leveraged fund is usually actually greater than 2 times over a longer period of time. So while your leverage strategy is 2 times, it's important to understand that you could have returns that are greater than 2 times, or even losses that are greater than 2 times in some scenarios. So important to understand the compounding, and that's something that we'll get more into the math on in following slides. Now, how do leverage ETFs work? This is, in essence, what these ETFs seek to do. So with traditional index ETFs, you're looking at an ETF that's trying to generate the returns of an underlying index. So the most widely followed ETF in Canada is ticker symbol XIU, and it seeks to track the returns of the S&P TSX 60 index, which is the 60 largest stocks in Canada. Now, with that ETF, regardless of the period of time, when you sold that ETF, you would get the market returns of the stocks from the period that you bought the ETF to the period you sell. It tracks it over any type of period of time where the correlation is extremely high between the returns of the ETF and the returns of the underlying index. With a leverage ETF, because they're eliminating that unlimited risk associated with leverage, you actually end up with a strategy where the return is only designed for 1 day. And that in a nutshell is the real key to understanding these ETFs, is that they have a daily investment strategy, and that is to deliver 2 times long or negative 2 times short, or in some cases negative 1 time short, the underlying return of the index for that day. And so what I'm showing on this chart here is that these ETFs, when it comes to providing that daily exposure, are extraordinarily accurate in meeting that investment objective. We can see right here in the middle that within about 99% accuracy, in some cases more, the underlying index of these ETFs goes up, and these ETFs track it extraordinarily well on both a negative 2 times and positive 2 times on a daily basis. So that's the end investment goal of these strategies, is 2 times long or 2 times short on a daily basis. We can see again that on inverse ETFs, we also see that it meets that goal. So I'm just highlighting here that that's the intent and the investment strategy of these ETFs, and they do follow this investment objective remarkably well. There's a lot of people, when they talk about leverage ETFs, they say, oh, these don't track the underlying index, and beyond one day, that could be the case, but on that, for that investment objective of one day, they absolutely do. But for you as an investor, you need to understand that the investment objective for these ETFs is one day. Beyond one day, there's no telling what the return trajectory could be if you hold them beyond one day, and that's where some of the confusion generally arises on how these ETFs work. Again, I'm going to explain how this works then again, and I'm going to use the negative 1x and negative 2x example, just because 2 times is pretty easy to understand. So the way that these ETFs work then is, if you were to hold these beyond one day, you would see the return trajectory of your ETF potentially differ from what you would expect. So for on the S&P TSX 60, if you bought a 1 times long ETF and it went up 10% over the course of a week, you would expect your ETF to be up about 10% minus fees. That may not be the case with an inverse ETF. So for example, if we look at the return here on an index ETF, we can see that the day 1 return is 10%, fairly straightforward. With a negative 1 inverse ETF, we would see that the daily return would be negative 10%, and a negative 2 would be negative 20%. Again, because these ETFs track that daily benchmark extremely closely. But in order to eliminate that unlimited risk, we also need to understand that the exposure of these ETFs has to be reset back to 2 times or negative 1 time on a daily basis. So on a day 2 return here, we can see again that we have a negative 10% return and a negative 20% return. So typically you would expect your compounded 2-day return to be 21% on the index. On the negative, however, on the negative 1 inverse, it's not negative 21, it's negative 19, because you had negative 10%, then reset exposure. Again, it would be then negative 10% of that lower return. So you've compounded on the lower amount to get negative 19. Again, on negative 2 times, we would expect it over the period to be negative 40, but because we're compounding on less reset exposure, it's negative 36. And this is where the returns start to be a little bit different. It gets a lot more tricky to follow if we get into a volatile market, because obviously in a volatile market, you're having returns go up and down. So on a day 1 return, with an index ETF, we would see a 10% return. At day 2, you would see at day 1, you would see, I'm going to just restart that. On a day 1 return, you'd have a 10% index return. On negative inverse ETF, you'd have a negative 10% return. Again, very accurate on one day. Negative 20% on the one day. This is where things get tricky though. Let's say on that same example now, the market declines negative 10% the next day. Well, then we would see the negative 1 inverse ETF generate a 10% return that day, and we would see the negative 2 times inverse ETF generate a 20% because it's inversely correlated. Now, intuitively, you would expect that if it was 10% one day and negative 10% the next day, your compounded 2-day return would be negative 1%. And you would expect then, however, you start to see these returns start to look a bit stranger, with negative 1% on the negative 1 and negative 4 on the compounded 2 times daily. So again, the math sort of just works from the fact that these returns can start to be a little bit confusing as the volatility of the market changes. So it's really important with these ETFs to really understand the return trajectory of the ETFs. That is, understand not only that you're making the right call on the direction of the asset class you're investing in, but that asset class return trajectory is typically going to be either an upward or downward trend. In a volatile market, returns may be quite a bit different than what you might have been expecting. And so, of course, we've seen leveraged and inverse leveraged ETFs affected by record amounts of volatility back in the financial crisis. So if you recall, I mentioned that most leveraged ETFs were launched sort of in around the end of 2007, or start 2007 into throughout that year, and we had this unprecedented amount of volatility, which is up and down returns, sort of for the next 2 years, and that really created a whole bunch of very, very differing return trajectories that many people were probably not used to seeing in those ETFs. And so one of the other important things to understand too is so that your return trajectory with these ETFs really is a function of their volatility. So the higher the volatility of the underlying asset class that these ETFs invest in, the greater the return and risk potential is. So the variation in movement of returns greater than 1 day will certainly be impacted by the index volatility. So for something like S&P TSX 60 index, we would see maybe a volatility of about 13%. But in our most popular ETFs tend to be the more higher volatility ETFs. So that's gold, equities, oil, natural gas, and volatility. And of course, these are extraordinarily volatile asset classes. And as you can appreciate, they have high 1-day returns and high 1-day losses. And so the return trajectory of these ETFs can be very, very different than the underlying index if held beyond 1 day. And most beta pro investors actually like that because you can generate very high returns with a volatile ETF because you're magnifying volatility with leverage to get big 1-day returns, but also means that your return trajectory beyond 1 day can be very different than what you would have expected. So important to understand, the more volatile the underlying asset class, the more deviation you would get from your expected return profile over a longer period of time, and the higher likelihood of seeing big returns, but also big losses. A perfect example of that actually is a volatility ETF. Last year at during Brexit in late June, volatility spiked, and we saw the 2 times leveraged volatility ETF generate a 66% 1-day return the next day, which is extraordinary. That means if you had $100 invested, it would then be $166 the next day. 2 days later, we saw a 50% decline in the same ETF. So your $166 would have dropped down to about $80. And so that's really important to understand because clearly the risk in these is high. And you may hear friends and family who use leverage ETFs talk about the huge returns they can generate with these products. Typically, you don't hear about the huge losses as well. So one of the key tenets of investing, and it doesn't matter how complex an investment vehicle is, generally speaking, the higher return profile of an investment over time that's been generated with a higher risk profile. So people are clearly attracted to these riskier asset classes using leverage because they can generate higher short-term returns, but the trade-off there is they're taking on higher short-term risk as well. So just something to understand, and that's why one of the big takeaways from this presentation is to always recognize that you need to monitor these ETFs on a daily basis. I'm not going to say you need to buy and sell them on a daily basis. If you have an upward trending market, of course, you could hold some of these ETFs for an extended period of time, but if on the converse of that, you do want to make sure that you're looking at these strategies on a daily basis to make sure that the return trajectory they're generating falls in line with what you would be expecting from a return profile. So just a summary again on the performance summary. The leverage ETFs track 2 times and plus and negative 2 times extremely well on a daily basis, and over periods longer than 1 day, performance tends to be market path dependent. So you want to focus on your exposure, understand its volatility. Directional markets are favorable for performance. You can hold these ETFs well beyond 1 day in a trending upward market. I believe in 2012, 2013, we saw 2 times leverage U.S. equities. Actually, we saw more than 2 times return on leverage U.S. equities without having to rebalance. On the converse, though, for something like volatility, you probably have to have a shorter time horizon in which to rebalance your exposure, because volatility is, no surprise, volatile in terms of the underlying. So the greater the two-way volatility, the further performance will deviate, potentially be worse from the period return that you would expect. Just going to check to see if there's any questions here. No, everyone's good so far. All right, that's just the basics of how these work. I'm now going to talk about the volatility and commodity leverage ETFs. And the reason I like to carve out this is because essentially what we end up seeing is most of the assets flowing towards these higher risk leverage ETFs. So the first part of my presentation, I was really referring to directionality of returns. That is, if you buy a leverage ETF on equities, so let's say the S&P TSX 60 or the S&P 500, you need to get 2 things right. You need to get the direction of the underlying index call right, and you need to get the path dependency, that is the volatility hopefully working or trending in your favor. With commodity and volatility ETFs, there's a third thing that you need to get right, and this is where a lot of investors end up getting confused when they invest in it, and that's looking at the contango and backwardation of commodity ETFs. So commodity ETFs all invest in, and volatility ETFs all invest in futures contracts. And futures contracts are basically a mechanism through which people look at the future price of something and expect it to go either up or down. Now, with something like crude oil, for example, there's a cost of storage built into for futures contracts. So in the market, traders are trading futures contracts. Somebody's trading one for delivery, and someone's trading one to deliver that commodity. Well, think about it on the short side. The person who's entrusted with delivering on a certain date, they have to pay for storage of the underlying commodity. And storing oil and natural gas is not as easy as just putting some space in your backyard to store massive barrels of oil. So there's a cost of storage, and that cost manifests itself as a premium that you pay to be invested in that commodity. So the longer you hold a commodity month over month, the more you pay some of these storage costs. Well, these storage costs, which generally, and also some people might sell to you thinking that the value of something is going to go up. So they're willing to deliver for a price today at a certain value, but they think that 2 months from now, the value of that commodity might go up. So they're charging you more to get exposure longer out on the futures curve, which means, again, you're paying a premium. That premium is referred to in futures jargon as contango. And it's when the futures price is above the expected futures spot price. And so the value of the futures contracts will decrease as they converge with the spot price. Well, of course, you as an investor want the value of your futures contracts to increase as they converge with the spot price. So what that means is if you're buying a leveraged commodity ETF, you need to ensure that the value of that ETF, the value of the spot price of the commodity, not only increases from the current price you pay, but it also increases more than the premium you're paying to roll those contracts in order to generate a positive return. So you could technically invest in a oil ETF that has crude oil futures, and it may not increase in value at all, or may only increase moderately, but you could still lose money because you have the contango premium has eroded your return. Now, when you add in something like leverage, you've actually got to generate 2 times that contango cost. That contango cost is now 2 times higher, moving against you. So you need to generate an even higher return to move against that contango. And for this reason, if you end up in a market where commodity prices are range bound or not moving a lot to the upside or downside, you can actually just the upside on the long side, you can actually lose quite a bit of money in these strategies. So for that reason, if you are a leveraged commodity ETF investor, you need to get 3 things right. You need to get the direction of the asset class going in the direction you think it's going to go. So in this case, we're just going to go talk about long. So if we're buying an oil ETF, we need to make sure that the price of crude oil futures are going up. We need to make sure that the price of crude oil futures is somewhat of an upward trending market. We can't have it volatility, because then we get that volatility drag working against us. And thirdly, we need to make sure that the price of oil futures is going to be higher, substantially higher than the spot price, or noticeably higher than the spot price, to account for that contango. So you want your price of your futures to increase more than what you paid for those futures to account for that contango. So those 3 things have to be right. On the flip side, you also have something called backwardation, and that's when the futures price is below the expected futures price, and the value of the futures prices will increase as they converge the spot price. This doesn't happen quite as often. It does happen from time to time, but certainly in a raging oil market, for example, no one's bothering to store oil. It's all being taken from demand, and so you can end up in areas where there's less supply than demand, and you end up with backwardation. Also important to understand is that if you are short, if you are short a commodity, that means you're taking the short side of a futures contract, you have contango working in your favor. And this is why a lot of futures traders end up actually being on the short side of contracts more than the long side of contracts, because they're being paid to hold the commodity, and so they make an income off that commodity, in perpetuity sometimes. And if you're leveraged on the short side, you're now getting 2 times that premium paid towards you. So very important. If I had a piece of feedback for any of you looking to invest in leveraged commodity ETFs, such as natural gas, oil, or volatility, always think of both sides of the trade, not just the long side of the trade. It's not good enough to think that oil today at $46 is going to be at $55 in 3 months. You need to think about how it is going to get there, and over what time horizon. If that's your view on oil, you might actually be, it may be a bit counterintuitive, but you might be better off to be on the short side and make all of that contango premium, that what we call premium roll yield with the contracts, in your favor as you wait for oil to go up in that price and then move to the long side. So commodity futures traders are always playing both sides of the trade, and if you want to be serious about investing in commodities, you probably should be looking at both the long side and the short side of those trades. Now, the way to understand the pricing on these commodity ETFs is also a little bit difficult, because again, they're rolling from one contract to the other. So here I have an example, and you can find these on our website when you go to the holdings tab at horizonsetfs.com for the ETF you're looking at. But you can see here, I just took a snapshot from April 6, 2017, that in April 6, 2017, our natural gas ETF, HNU, was 75% in the next month contract, May, and it was 25% in the further out contract, June. So that means the price of the ETF was a combination of the May and June pricing. Now you can find this information on the pricing at this link here. It says click here for more information on natural gas futures. You can click on that and it will come up as the May and June contract. So we can see that basically the price at that time for the May contract was 3.25, and the price for the June contract was 3.32. So the combination of this times 75% and this times 25% times 2 gave you the valuation of that ETF. A lot of times we'll have people calling us saying, you know, natural gas spot price is up 4% today, but potentially the contract of the ETF is probably moved more towards this contract here, which is already a higher price, and so the near-term price movement in the contract is not reflected in the value of the ETF. Very important that you understand the pricing mechanism, and you can easily find that again by going to the holdings page and looking at what the weight is of the contracts it holds and in what proportion, which can be addressed here. We also have a calendar. So for any of the energy ETFs we offer, such as natural gas or oil, we roll them over a period each month over the course of a week. Generally speaking, it's very important to understand it doesn't impact your exposure too much, but you should know this is occurring. We don't all roll it at once. Clearly, we have hundreds of millions of dollars invested in these ETFs, and we want to have an orderly roll of the exposure from month to month. So typically during, as we can see here, the first Friday of the month in January, sorry, I'm going to go back there, we were moving towards, I'll get the highlighter, we were moving from the contract 25% a day. So on this first Friday, the 6th of the month, we started moving from 75 to the near month, 50, 25, until we were 100. And that continued until we got to essentially the 6th of the next month, and then rolled it once again. So we're rolling that exposure every month, and that's where you'll see those contracts starting to change, and then they'll be 100% invested in one contract for most of the rest of the month. Perfect. Okay. Now, one of our most popular lines of leverage ETFs over the last few years has been volatility. And if any of you are leverage ETF investors, you've probably seen lots of bulletin boards online, or maybe you've talked to cab drivers. I've met so many cab drivers that love this ETF, talking about investing in volatility. When's volatility going to spike? And this is, very much long volatility is sort of, to use a lack of a better term, sort of the roulette wheel of ETFs, in that you can generate extraordinarily high one-day returns. I highlighted that 66% return back in June of last year, and you can lose a lot of times too. But what's really important to understand with volatility is that they're not necessarily tracking the VIX. So the VIX, which is called the SIBO Volatility Index, is not an investable index. So instead, there's indexes that are created that invest in VIX options, which are daily options that provide exposure to the VIX. And that gives you a correlated performance to what you would expect the volatility of U.S. equities to be. So with the Horizons Beta Pro VIX short-term futures, 1x long volatility, you get 1x the daily performance of that volatility index. With the HVU, U for up, you get 2x the daily performance of the index. With the HVI, you get -1x the daily performance of the index. But unlike the commodity ETFs, the way that options trade or tend to be on one day, VIX options, they have 1 month periods, but the roll has to be significantly different in order to maintain that exposure. So we actually roll these ETFs over a 60-day period, and they're rolling on a daily basis. So you end up with a very different type of exposure. Again, similar to the energy ETFs, you can go and look at the commodity exposure under the holdings. For here, you can see that the VIX short-term future in September of 2016 was 79% roughly in the September contract, and 20%, 21% almost in the October contract. And you can click a link and see where the pricing is on these two contracts. One's at 16.65, and the other one's at 14.60. So a combination of those two provides you the combination of the value. Important to understand that VIX, even though there's no storage, you can see here there is a contango cost. So VIX probably actually has one of the highest roll yields of any futures contracts on average. So again, if you're investing in volatility to spike, you really have to be precise in your call to get that right, because you're paying a premium to roll each of these contracts. And unlike energy contracts, you're rolling them on a daily basis. So you're accruing that roll yield against you on a daily basis. What I want to highlight is that, again, these ETFs provide extraordinarily close returns to what they're supposed to do. All I'm showing here is that the tracking error of the 2 times long leverage ETFs, even on a contracts where it was 83% in one and 16% in the other, is extremely close. But these contracts can behave very differently. The September and October contracts, as you can see, it can be priced quite a bit differently, so you may be a bit confused as to what's happening with volatility and where the pricing of these ETFs are. They are highly correlated to volatility, but they're not necessarily precise representation of either the VIX nor the near contract, that is the most immediate VIX futures contract. So you need to look at the underlying exposure to understand the holdings. This is extraordinarily complex. I'm not going to belabor this point here. It's just important to understand this is where the pricing mechanism comes from. And this is just sort of the performance we've seen of that 2 times daily bull ETF. Notice here there's never been a positive period return for this. So I sell this ETF as for Horizons ETFs, and under no circumstances anyone holding this beyond one period greater than a day made any money over the last 5 years, generally speaking. And that's because the level of contango to be in this ETF. So there are periods where you get those 1 day huge spikes where you make a lot of money, or maybe 2 or 3 day periods but you can see that this has been an absolutely horrendous ETF to own for longer periods of time, because you see the erosion of those returns as you hold it. On the converse, you can imagine the inverse volatility, because you're getting the roll yield to your advantage, has had very positive returns. But the futures exposure rolls with these ETFs, usually we started around the around the 21st of each month, and it starts to roll on a daily basis to the next calendar month. So you can see here that in October we were 100% and September 20th we're 100% October, and then we immediately started rolling so that we were 100% November by the 18th of the next month. So on a daily basis, rolling constantly towards that other contract, usually in the vicinity of 4 to 5% a day, depending on how many days are in the month. Other thing to understand is the hours that these ETFs trade. So for something like the volatility ETFs, they actually the underlying futures trade another 15 minutes after the market close in Canada. So the price return, the NAV return of volatility can spike at the end of the day. And in fact, it does tend to spike or move around quite a bit in the last 15 minutes a day. The most volatile periods of the market are the open and close of the market. So where the price of volatility could have moved quite a bit from the last 15 minutes of the day from where your ETF closed. Generally, the next day, that exposure would be reset so that it captures that movement of volatility, but it would not necessarily be reflected in the end of day pricing. Again, this is complexities. These are complex ETFs. These are ETFs that I only recommend to very veteran or experienced ETF investors who have experience with day trading. If you're an ETF investor who tends to look at things on a month-to-month basis or year-to-year basis, I'm actually going to suggest these are probably not the most appropriate ETF for you to use, despite the attraction of the high levels of return. The exception being the inverse ETF, where obviously you have a little bit more forgiveness because you have the roll yield working to your favor. But there is a bit of a buyer beware of these ETFs. We certainly have experienced ETF traders who make a lot of money trading these ETFs, but they are not for people who want to set and forget their exposure. These are complex, their pricing is complex, and they tend to have big movements on a regular basis. So other things to note as we move forward on leveraged ETFs, and I'm kind of moving up to my 45 minutes here, is always use limit orders. So if you're not familiar with limit orders, I'm sure iTRADE has a few guides on that, but generally speaking, set a price that you want to execute. Do never put a market order into these ETFs. That's incredibly important. As you can appreciate, because you're working with leverage, the prices can move away from you quickly. These are extraordinarily liquid and high volume ETFs, so pricing execution and getting execution is not very difficult, but the underlying market itself can move quite quickly. As an investor, you should have a price that you're happy to execute at and sell at. In both cases, we suggest you use a limit order. And in fact, if you're going to use stop losses, I would say use a limit stop order again. So not just a negative stop loss, there's a stop limit order on the price that you would like it to come out at if it moves beyond. And I think the use for leverage ETFs, using limit orders and limit stop orders, is absolutely crucial because these move quickly in different directions, and of course you have a portfolio strategy you're trying to execute. And if you can't be monitoring your positions on a frequent basis, then you need to be using these strategies to maintain that your pricing falls in line with what you want the ETFs to actually do. Also going to say you should always stay away from trading orders at the beginning and the end of the trading days. This is because all these ETFs are resetting their exposure. So the pricing can move quite a bit different from the underlying value of the asset classes in the first 15 minutes and the last 15 minutes of the day. There's no reason for you as an end investor to be trading at these times of the day. I usually suggest to investors to start your ETF trading if you're going to be trading these during the day at around 10:15 and try to get out around 3:15 for end of day. Otherwise, what you're doing is you're basically investing in the resetting of contract exposures that all the large institutional market makers that manage these are engaging in, and your price and fill orders could be very different than the underlying movement as those large investors who hold the majority of these ETFs start to reset their exposure. So try to keep your trading, I guess, for to keep it simple, 10 to 3 p.m. during the day. Look at the market depth and size of the ETFs and the market bid and the offer. That's really not a problem with leverage ETFs. There's a substantial amount of volume in these ETFs. And also try to determine where there's a sizable bid or offer. That is where you can likely transact. Again, that's just looking at the bid and the offer and making sure that in between there is probably the price that you'll be able to get. And if you use a limit order, you make that even more precise. So here's again all the tickers and asset classes we offer, everything from large cap Canadian equities, financials, energy, gold, US equities, NASDAQ, then physical commodities, gold, silver, crude oil, natural gas, and of course those high torque, high risk, high reward volatility ETFs. All these ETFs have a management fee of 1.15%. So that'd be accrued daily as you hold them, and on an annual basis would be 1.15%. You can see the average trading volume on all these ETFs is quite significant, allowing for easy execution to get in and out of those trades. So with that, I will just do a quick summary. Leverage ETFs allow you to investors to increase their exposure to existing indices. These are ETFs if you have conviction that something's going to go up or down. These are not ETFs where you think that they might go up or down. You have to have a lot of conviction that you think an asset class is going to go up or down, because then you're taking on additional risk to get that additional return. You can take advantage of directional markets, and you should always recognize the effects of compounding and volatility and try to invest strategically and transact with care. All right. Thank you very much, everybody. I hope I'm going to just check the questions here. I'm assuming there's probably got to be a couple here. We covered a lot of complexity here. Can you give a brief overview of HFD, the Cap Financials 2x Daily Bear ETF? If expecting a housing crash, is this an appropriate big short investment? Thanks. I've been asked this question a number of times, and technically I'm not surprised. I don't want this to be misconstrued as financial advice. Obviously, the banks have some stake in the Canadian housing market, and there likely would be some contagion there, but it's not a pure short the same way that you might think with some of the U.S. financials back in the 2008-2009 financial crisis. And that's because a lot of the high-risk mortgages in Canada are already publicly secured by CMHC. So a lot of people are obviously looking for ways to short the Canadian housing market, given where valuations are, but the financials are probably not the best pure play there. There's not a whole lot of pure plays. Probably the housing lenders, we've seen what's happened with Home Capital Group, are some areas where you may be able to get some of that exposure but I would be very hesitant to suggest that taking a bet on a 2 times daily financials ETF would see a big pop if there was a meaningful housing crash. Certainly, there probably would be an ancillary impact on the Canadian banks because they're bellwethers of the Canadian economy, but it may not be your best pure play there. And the other thing is, just based on what we were talking about in this presentation, given the time horizon for a housing crash, we could be 2 to 3, maybe 10 years from a correction. We don't know. You never know when you're in a bubble till it pops. And these ETFs tend to be much shorter term in their nature of their investment horizon. So you could be insolvent before that trade actually worked in your favor. So unfortunately, I know a lot of people looking to find ways to short the Canadian housing market. I don't think this would be an appropriate way to do that because of that short-term risk. Any other questions? Okay, well, without that, I'll turn it back over to Conleaf. Thank you.
Thank you, Mark. That was a very interesting and informative presentation. And if you have any other questions for Mark, please feel free to send them to me at education@scotiaitrade.com. Again, that's education@scotiaitrade.com, and I will forward them over to Mark for a response and get back to you. So getting back into our presentation here, what's next? You can access webinars, as we mentioned, on our YouTube channel, or you can email us at education@scotiaitrade.com. We had mentioned that just now. Mark, you might want to mute there.
Oh, sorry.
No worries. After you exit the webinar session, a short survey will load in your web browser. We just ask that you complete this survey, as it will help us to address your concerns and to also orient our webinar offerings to meet your investing needs and help you to reach your goals. Coming next, we have some additional webinars that you may be interested in. On Thursday, May the 11th at 1 p.m., the market guys will be presenting the power of the put options. Now, this will be directed towards the level 2, learn more investor. So if you're interested, just go to our events calendar and register for that. Also, too, on Tuesday, May the 16th at 1 p.m., Pro Market Advisors will be presenting a webinar on index from condors. And that's more of an advanced webinar. It's sharpen your skills. So on our events calendar, as mentioned, you'll be able to find and register for those. We also are going to be providing Wednesday, actually tomorrow, May 10th, sustainable investing. As you may have been aware, Scotia iTRADE is one of the first direct brokerage to offer sustainable investing research to the retail client. So if you're one of those Canadians that is interested in your personal values and beliefs being reflected in your investments, this would be for you. So tomorrow at 1 o'clock, May the 10th, Sustainalytics will be providing us with an overview of their sustainable analytics tool, and we'll be presenting the actual deck as well too. So please feel free to join in for that. As mentioned, you can actually find our webinars for registration under our Education tab under the Events calendar. Just click on that, and you'll see our assortment of webinars that you can register for. So on behalf of Scotia iTRADE, I would like to thank Mark and Horizons ETFs for that amazing presentation. And I'd like to also thank you for joining in and for remaining with us. We ask that you complete the survey and let us know if you have any comments for improvement. And if that be it, I don't see any other questions. I am going to now upload the handout for you. It just takes me a few seconds here. Okay, that's being done. Just bear with me. A few more seconds. And done. So the handout is now available for you to download. I'll leave that there for a few minutes, and If you have any other questions following this, just email me at education@scotiaitrade.com. Thank you so much, and have yourself a very good afternoon. Take care.